Ever wondered how top traders anticipate market movements with such precision? It's not just intuition, it's about mastering the tools of the trade, and among the most powerful are option chains and the put-call ratio, or PCR. Options trading isn't just a corner of the financial markets, it's a bustling hub of activity that offers deep insights into market sentiment. An option chain presents various options contracts available for a particular security, detailing strike prices, expiration dates, and whether they are calls or puts. This information is crucial as it reflects trader expectations and potential market movements. Understanding the put-call ratio further enriches this landscape. The PCR compares the volume of traded put options to call options, serving as a barometer for market mood, bearish or bullish. In the coming scenes, we'll delve deeper into how these tools are used by seasoned traders to gauge future market behaviors, craft strategies, and make informed decisions. Stay tuned as we decode the mysteries of option chains and PCR, turning complex data into actionable insights. Dive into the core of options trading, the option chain. Imagine the option chain as a detailed map, guiding traders through the complex terrain of the stock market. This tool is essential for anyone looking to engage in options trading, as it provides a comprehensive snapshot of all available options for a particular stock or index at various expiration dates. At its heart, an option chain lists all the put and call options available for a specific security. These are categorized by their expiration date, ranging from days to months, or even years into the future, and by their strike price, the predetermined price at which the holder of the option can buy or sell the underlying asset. Each option within the chain is a potential strategy waiting to be deployed, but understanding the details is key. Let's break it down. The call options are bets that prices will rise, allowing holders to buy at today's prices tomorrow. Conversely, put options are wagers that prices will fall, offering the opportunity to sell at a fixed price even if the market drops. Moving deeper, the volume and open interest are indicators of how many contracts are actively traded and how many are established, respectively. A high volume can suggest a strong interest in that option at its current price, while a significant open interest indicates a lot of money tied up in that particular strike and expiration. These elements, when analyzed together, serve as a barometer for market sentiment. For instance, a high volume of calls at a strike price above the current stock price might indicate optimism that the stock will rise to that level. Similarly, an accumulation of puts at a lower strike could signal market fears of a decline. Understanding these signals within the option chain helps traders anticipate potential price movements and align their strategies accordingly. It's not just about predictions, but about preparing for various market scenarios. With this foundational knowledge, you're ready to explore deeper into how these numbers can guide your trading strategies. Now, let's shift our focus to a critical metric, the put-call ratio. The put-call ratio, often abbreviated as PCR, is a popular tool used in options trading to gauge the overall sentiment of the market. But what exactly is it? Simply put, PCR is the ratio of the total number of put options traded to the number of call options traded over a given period. This ratio can provide a snapshot of investor sentiment towards a particular stock or the market as a whole. To calculate the put-call ratio, you divide the number of traded put options by the number of traded call options. For instance, if on a particular day, 10,000 put options and 20,000 call options are traded on a stock, the PCR would be 0.5. This calculation helps traders understand the prevailing trading tendencies, whether there's a leaning towards expecting the market to fall or to rise. Now, let's delve into what these numbers can tell us about market sentiment. A high PCR, typically above 1, suggests that more puts are being bought relative to calls. This is often interpreted as a bearish sentiment, indicating that investors expect the market to decline. Conversely, a low PCR, less than 1, suggests a bullish sentiment, indicating that more investors are betting on the market to rise by purchasing more calls relative to puts. But why does this matter? The PCR is a contrarian indicator. In the complex dance of the markets, if most traders are leaning heavily towards a bearish outlook, it might suggest that a market bottom is near, as pessimism has peaked. Similarly, an extremely low PCR might indicate excessive optimism, potentially signaling a market top. Understanding PCR helps traders gauge the mood of the market, but how do we use this information practically? Let's explore that in our next segment. Having the data is one thing, but using it effectively is where the magic happens. In the world of trading, an option chain isn't just a list of prices and dates, it's a treasure map, guiding savvy investors to make informed decisions. Let's explore how you can use this map to find trading treasure. First, consider the role of high-volume strikes in an option chain. High volume indicates a lot of trading activity for a particular strike price. Why does this matter? Because high activity often signals strong interest or significant resistance at that price level. For instance, if you notice an unusually high volume on a call option at a strike price of $200, it suggests that many traders expect the stock to rise to or above this level. This can be a potent cue for you to consider entering a position, anticipating upward momentum. Now, let's delve into the realm of implied volatility. This metric reflects the market's forecast of a likely movement in the stock price. Generally, a higher implied volatility suggests that the market expects significant price movement, but the direction of the move is not indicated. How can you use this? If you're eyeing an option with high implied volatility, you might be looking at potentially higher premiums if you're an option seller, or more costly options if you're buying. This can influence your strategy, perhaps steering you toward selling options to collect higher premiums in times of elevated volatility. Moreover, the insights gained from these metrics aren't just for individual stock options. They can be applied to index options, giving you a broader view of market sentiment and potential trends. This broader perspective can be crucial during market-wide events or fluctuations, allowing you to adjust your portfolio strategy to either hedge existing positions or to take advantage of anticipated movements. Leverage these insights from option chains, and you transform data into a strategic trading advantage. Combine the power of PCR with your trading strategy for enhanced decision-making. The put-call ratio, or PCR, is more than just a set of numbers. It's a beacon for market sentiment, guiding traders through the fog of market uncertainties. So how exactly do you weave PCR into your trading approach? Let's start by understanding its implications. A high PCR, which implies more puts are being bought compared to calls, often signals a bearish outlook among investors. They are hedging against or betting on a potential decline in the market. In such cases, it might be wise to consider defensive strategies. This could include opting for stable dividend-paying stocks or even looking into safer asset classes like bonds. On the flip side, a low PCR suggests a bullish sentiment. More calls are being bought as traders anticipate rising prices. Here, the door opens for adopting more aggressive trading positions. Consider increasing your exposure to growth stocks or sectors showing robust performance. It's also a prime time to explore option strategies that benefit from upward movements, such as buying calls or selling puts. But remember, PCR should not be used in isolation. The real magic happens when you combine it with other market indicators. For instance, if the PCR is high and you notice a significant uptick in volatility indices like the VIX, it reinforces the need for caution. Conversely, a low PCR combined with strong market fundamentals and positive earnings reports could confirm a solid ground for aggressive trading strategies. Timing is crucial. Monitor PCR trends over time to catch shifts in market sentiment. Sudden changes in the ratio can prelude major market moves, giving you the chance to adjust your strategies proactively. Incorporating PCR into your trading decisions is like adding a high-powered scope to your market vision. It allows you to see beyond the immediate horizon, preparing you for potential shifts before they fully manifest. Integrating PCR with other market indicators fortifies your trading decisions against unexpected market swings. Let's quickly recap the key insights we've uncovered today. We started by diving into the mysterious world of traders, revealing that option chains and the put-call ratio, or PCR, are not just tools, but the very language of the market. Understanding an option chain gives us a comprehensive view of the various strike prices, expiration dates, and whether options are being bought or sold. It's like having a map in a treasure hunt, where each symbol and number provides crucial clues about market sentiment. Then we explored the PCR, which measures how many put options are being traded compared to call options. A high PCR suggests a bearish mood, while a low PCR indicates bullish sentiments. This ratio is pivotal for predicting market turns, enabling traders to position themselves advantageously in anticipation of market movements. Lastly, we discussed how both these tools can refine trading strategies. They help traders gauge market dynamics and make decisions that are not just informed, but strategic. Armed with the knowledge of option chains and PCR, you are now better equipped to navigate the complexities of the trading world. Happy trading!